Hey everybody, welcome back to the channel for a very special video today. And I'm joined by Hamilton ETFs, Rob Wessel, the main man at Hamilton ETFs. First of all, Rob, thanks so much for making the time. This was a short notice. And of course, we're going to be talking about the HYLD distribution cut, which was just announced from 14 cents a month to 12 cents a month. We'll talk all about it, the reasons why
Sure.
it was very, very well justified. And the first thing I will tell my audience is if you're following along, make sure, in case you haven't done it yet, read the article or at least bring it up on your screen because we're going to be talking a lot about the graphs in there. And, there's a lot of graphs and explanation. So go on Hamilton ETF's website, click on HYLD, and in the articles, you should see the article there, which talks about not only the changes, the holding changes of HYLD, but also the distribution cut. So, Rob, welcome. Thanks so much for joining us today on such short notice. How's it
No,
going?
thank you so much. We happy to join the channel, and we're happy to have the opportunity to speak to your followers and talk about talk about what we're doing and why.
Yeah, always appreciate that, and so do the owners, of course, of all your products as well. So let's get in it right away. HYLD recently announced a distribution reduction of about 14%, 14
Mhm.
cents a month to 12 cents a month. So what would you say if I would just ask you why? What would be the main
Yeah.
reasons behind it? I know there's several.
So so we've been on the channel many times, and when we talk about how we think about the distributions for HYLD and HDIV, generally speaking, we are trying to have a distribution that is um, pretty close to whatever the underlying yields are, portfolio weighted, times 1.25 to take into account the leverage, the
Yeah.
modest leverage. So we'd like the distribution to be roughly equal to that. Now, having said that, at the same time, we also would like to deliver returns that are relatively stable. So we don't want to be overly rigid. We'd like to be flexible, especially because in the instance of HYLD, the holdings of the funds, most of them have variable distributions. So there is an element of moving around. HDIV, the holdings have more stable distributions because they have a different cover call strategy. It obviously has a bit lower yield as well. But the fact is HYLD is heavily represented and invested in some high quality covered call ETFs that many of which have variable distributions. And so we're trying to make sure that we follow that sort of basic rule of thumb. So here we are today. And if you don't, is it okay if I share my screen?
Yeah, go ahead.
Yeah. So for those who can see,
And by the way, this is from the article, right? This is all in the
yes.
article. You're actually showing the article, but
Yeah, so this is an article on our website or an insight on our website. So we have a rule of thumb. So what we really are looking for is each month thinking about what's the underlying yield times 1.25 and what's the difference between that and the yield for HYLD. So when we launched the fund, ideally this number is positive. We launched the fund, it was positive, and some market movements and other changes got us closer to 2%, this band. We want to be, generally speaking, within one or two, plus one or minus one.
yeah.
And we're okay being in here. That's not that big a deal. If you get to two, though, we just want to, we want to probably take action. So here we got to close to two, and we, in and around here, we increased the distribution. So right around here, Q yield, R yield, and X yield, which were at the time 50% of the fund, give or take,
Yeah, big chunk.
because
Yeah.
volatility was declining, their distributions were gradually declining. And that was bringing these numbers, this difference or delta, down to closer to zero. There was some market movements over here and changes in volatility. It moved outside. We didn't want to do anything, so we didn't. And happily, it started to close. And so at the whole time, their distributions are trending down. And then we added JEPI and JEPQ, and they made some notable declines. So the cumulative impact of Q yield, R yield, and X yields, their declines, combined with the notable decline in JEPI, JEPQ, took this difference to minus 2%. And we just think that's too large. So what we thought we would do is, or what we did do, is we moved it to 12%, which took that delta back to plus 1%. So, I mean, there's two things that are going on here. The first is we want you to have stable distributions, and we want to do our best to deliver that. At the same time, we also want to make sure this is a good fund 5 years from now.
Yeah.
So we don't mind if this bounces around, but for those people who are watching and you want to own this fund for 4 or 5 years, we want to make sure that over time the distributions are funded and that we don't have a large structural grind. We're okay at the margins if things move around, and because at the end of the day, the underlying ETFs have variable distributions themselves, and all of this is somewhat with the benefit of hindsight. You know, we it's hard to predict what forward volatility is going to be.
Yeah.
So in the interest of keeping them stable, it was in that plus or minus one range. We were okay with that. But when it got to two, especially minus two,
-2. Yeah.
we felt we should probably act. And so how we got to 14 cents or 12 to 12 cents is that took us to exactly 1%. If you don't mind me pointing out,
Yeah.
HDIP, we follow the exact same rule of thumb, but because the underlying ETFs, it has a lower yield, but it has a different constituency. The ETFs there don't have the same variability distribution. We've kind of been able to set it, and you can see that throughout its almost the entire time, we have been able to more than fully fund the distribution. In fact, we're now up to 2%. So, you know, we'll have to consider how we want to proceed. But this is, you know, this is a good spot to be. This is easier to accomplish for the Canadian funds. They do have lower payout ratios and lower yields than it is for HYLD. This one here, because there's 5 funds moving around. But at the end of the day, we want this to be a good number. And the reason for that is we want you to think this is a good fund, and we want it to be a good fund for many, many years.
Okay, so just a couple of things, just in case I'm talking to my audience members here, and Rob, just step in and correct me if I'm wrong. If you're having trouble understanding what this chart is, basically every single month for both the HYLD, the HDIV, if it's at 0, it means they're paying out 100% of the yield, basically. So the payout ratio is 100% if it's at 0. If it's at 1%, or more closer to 2% like HDIV is right now, it means they're actually paying out about 98% payout ratio. So they're paying out 2% less than what HDIV, all the income and yield that HDIV is making right now. But for HYLD in the last couple of months, I would say starting in really in September, October, November, the fact that, and this is what Rob was saying, because there's a lot of covered call ETFs on the US market, unlike the Canadian ones, they have variable distributions. Yeah. The Q yield, R yield, X yield ones have gone down, and you could see that clearly happening in September, October, November. And if you go to QYLD, RYLD, XYLD's website, look on the distributions, you can clearly see, 20 cents, 18 cents, 16 cents. And by the way, I'm talking to my audience here. I have 2 videos coming out where I will go in detail on QYLD, RYLD, XYLD, and how the distributions work, what the distribution policy is, how can you could expect, what kind of dividend you could expect next month, because it's actually a very easy process, and it's a set in stone systematic process to figure out. And in the second video, I'm going to be talking to Global X, the income director of Global X, to confirm everything. So stay tuned for those 2 videos. It's actually a follow-up on the JEPI and JEPQ 2 videos that I just did, one with Hamilton Rayner, the fund manager, and one where I review it. So I'm basically going to do the same thing. And in case you haven't seen the JEPI, JEPQ video, go see them, because it explains why there's a variability in the monthly distributions, which is very relevant to HYLD, because those are the funds inside HYLD. Yeah. Second thing, if I may, Rob, second thing, sure. This is not a big grind or it's not like you're paying out 100 and it's 10% or 100 and 20%. This is just 2%, guys. So it literally means in the last month in March, where you actually see that it went to the minus.
And that's annualized.
That's annualized. Yeah,
Right.
that's annual. Yeah, for sure.
That
Annualize
would
it.
be for the whole year if we kept it there.
Right. But it's
Yeah,
specifically in March. If you would have kept the 14 cents, for example, the payout ratio is 102%.
correct.
So it's not like it's
Roughly.
100 and it's not like it was only
No,
2%,
no.
which is actually very small. And like we discussed earlier, you kind of waited. Maybe the distributions of the underlying were going to go back up, but they haven't. So the third thing I would say to the audience is the main question should be, it's not really HYLD, it's what the underlying do,
Mm.
and you have to understand the distribution policies of JEPI and JEPQ, which, like I explained in the video, it's all based on volatility. Volatility actually goes down when the markets are doing well, guys. So this is a very important thing a lot of people don't understand. Volatility is typically happens when the markets are very unstable, when they're going down. That actually gets JEPI and JEPQ's distributions to become higher. But for Q yield, R yield, and X yield, it's kind of the opposite because of their own distribution yield. So I don't want to go too crazy on this right now. Just remember that I have two videos coming up for the Global X ones, and I already have two videos out for the JP Morgan one
And
explaining
and
this, right?
and if you think it'd be helpful, Adrian, why
Yeah,
don't I share my screen to show
please.
the VIX?
Show the VIX, exactly. So, by the way, when we talk about volatility, when I say volatility, the best way to look at it is look at what the VIX is doing. The VIX is a measure of volatility of the overall market. Correct me if I'm wrong, Rob. It's the
Yeah.
volatility of the S&P 500,
Yeah, so it's
right?
the CBOI Volatility Index. So this is over the last year. So it's important to point out that these JP Morgan funds are excellent funds. The Global X funds are good
Yeah,
funds. And so it's not a function of them, doing a bad job or anything like that. It's that when HYLD was, let's call it almost a year ago, the VIX, which is a general, many people call it the fear index, but it's a
yeah,
volatility index. So it's up here around 35. So it's falling, and then this is market volatility. But what you can see is it trending down,
yeah,
and this is giving less premium income and less premium support to these underlying ETFs. So it's not that the managers are doing anything wrong or that
yeah.
this has anything to do with the quality of the underlying funds. They, cover call strategies generate more premium income when it's more volatile. And here's where you kind of get into the JEPI, where you had a large decline in the VIX from basically 26 to 16. And
Exactly. And
so,
I was looking at it before, and the proof is in the pudding. If you actually look at JEPI's distributions in September and October, when you see the spike of the VIX, they're a lot higher than they are now. So the proof is in the pudding when it comes to JEPI and JEPQ, everyone. Volatility, which means typically the markets are going down, it spikes the VIX, which is actually, you could expect higher distributions for JEPI and JEPQ. But when the market starts doing well, like it has been doing in the last couple of months, where you see the VIX is going to go down. So a lot of people need to, it's the opposite, right? The VIX kind of does the opposite.
and 16 is certainly given all the macro uncertainty, that's a fairly big decline from in the 30s to 16. So therein lies, the gradual decline in the distributions. Of course, for Q yield, R yield, and X yield, they all declined.
Yeah.
So now we have taken some steps, and I know you're going to ask me about the changes that we've made to the portfolio that'll help, we think, go forward, reestablish and firm up, the consistency of the distribution, which has been consistent up to this point.
Yeah, perfect. So hopefully this is great conversation. By the way, really happy
Yeah,
to talk about this stuff. It's important to understand because it's very relevant to covered call strategies. People need to understand. I
absolutely.
try to tell them all this is not a dividend that's getting, or a dividend stock, or it's not because the market is doing bad. It's actually the opposite. When volatility spikes, that's what helps increase the premiums of covered call strategies. You clearly
Mm.
see that with JEPI and JEPQ, and even for QYLD, RYLD, XYLD. I show this in the video. I have to say it again. Every month, you can actually see the premium that they generate, and it is higher during volatility. But because of Global X's distribution policy, it basically follows the NAV. So it's a bit different than the JEPI and JEPQ. It's pretty much the opposite. The opposite. But I explained that in those videos. So
Mm.
before we get into the changes, because HYLD did do some holding changes, I just
Mhm.
want to talk about a little bit the math. So 14 cents to 12 cents, about a 14% distribution cut. And now the payout ratio went from, because of that cut, approximately 102 to 99, right? Because you're in plus one, which is 99. So
Mm.
give me the math behind the distribution cut, because it seems a little bit steep.
Well, that's the math. I mean, the math is, and it was, what was the distribution that got this to 1%?
Okay.
And that number was 12 cents. Had we gone to 13 cents, it would have been zero. So the payout ratio would have been 100%. But we feel that, like HDiv, which has a surplus, but
You
we
want
would
to
like
beat the
that payout
surplus.
ratio. Yeah, we would like it to be, we'd like it to be less than 100. I mean, we're not too fussed if it's at 100. And
Yeah.
as you can see here, we haven't been wildly fussed if it was at 99 point, or sorry, 100.5. But, I think, it makes sense for this distribution to be less than 100%. 99 is a good number. And I don't, and I want to be clear, we don't take this lightly. That, we know that people buy these funds, we know they have monthly income, we know that funds their expenses, so we don't make these decisions willy-nilly or anything like that. We take them seriously, but at the same time we also want the fund to be a good fund 4 years from now, 5 years from now. And if this number is, if the payout ratio, if we want to call it that, we'll call it our rule of thumb, your payout ratio as you defined it is 99%. That's a pretty good, that's a good, reasonable place to be. And that puts the fund in good long-term stable footing,
Yeah.
which is where
One
I
thing
think
I
everybody
would,
wants it.
for sure, for sure. And one thing I always hear for high yield funds, a lot of conservative investors, long term investors, retirees, for example, they always have a fear that they're paying out too much. They're grinding,
Mhm.
or AKA bad rock,
Yeah.
guys. Okay, that's what it is. And I have to commend Hamilton, because I have never seen a graph like this from any other fund provider where they actually show month per month the payout ratio percentage. And this actually proves that you guys are very, very against grinding whatsoever. You want to avoid that completely. This should bring comfort to long-term investors who don't want that bad rock, that want to get a like we've seen, a payout ratio that's 100% or less. And you guys are even trying to get a 1% cushion, which is more conservative. Do you agree with that assessment?
Yeah, I mean, we've been somewhat flexible, so there has been negative. It has been more than 100% for a little while. So now it's not been very significant, but still, I think
Right.
it's worth noting. But what's in the background here is the markets have kept falling. So, when people have, they think about rock, we obviously want to have, as we said, the yield of the underlying times 1.25. We want that to be more than what we're paying out. But we also would like the market to go up. And it would be
Yeah.
great if the market went up, because I think, that helps everything. And that way, if you have these little, small amount of leakages, they just get absorbed by market appreciation. Unfortunately, when we launched HYLD, two things happened. The market fell significantly and the Canadian dollar fell significantly.
That's
Now,
true.
HYLD is hedged to CAD. So
Hmm.
that's a very big delta. So you can't really compare HYLD to the S&P 500, because there's a big currency mix in there. You have to compare HYLD to, we think the Vanguard S&P CAD hedged is the best,
The hedge,
is
for
the
sure.
is a fair thing. But when you think about the distribution policy, I think as long as the market is challenged and volatility is low or lowish, then I think having a payout ratio that's less than 100% is a prudent thing, is a better place to be. If the market was going crazy and it was up, just going up, 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 that would be one thing, but it isn't. So
Yeah. Well, there you have it, guys. No grind with HYLD, and the fund managers, like we see, they're on top of it, looking at it every month. So it should bring comfort to people who automatically think high yield, they're overpaying. But even when it was overpaying temporarily, it was by 1% or 2 max. So it's not like it was the end of the world. That's how I see it anyway. So
Yeah.
we'll move on. We'll move on to the changes. So you guys introduced USCC and QQCC. Those are Horizons, which is the Canadian stock market covered call ETF. So QQCC is a Nasdaq 100 covered call ETF. USCC is pretty much large cap US, kind of like comparison to S&P 500,
Yeah.
more or less. So why did you guys decide to reduce the global X ones and add these ones? Speaking of market recovery, which has to do with it.
Yeah. So there was quite a few benefits to this, and some of it has to do with the substance of this conversation. So the first thing is that we are largely adapting cover calls on the exposures that are nearly identical to what we're giving up. So
Yeah.
it's basically a different covered call strategy on almost the exact same stocks. So as it relates to the sector mix, there's no change. We are getting ever closer to the S&P 500, ever closer to higher correlations, and we're happy about that. The second thing is the yield of what we bought, net of withholding taxes, is notably higher than what we sold. So you may recall that we have that HYLD has lagged the VSP, the Vanguard S&P Hedge to CAD, by about 3%. It bounces around. Sometimes it's been as low as 0. Sometimes we've been above, but it's -3 right now. And a big variable for that was withholding taxes,
right?
Because we had these higher yielding. So this actually ameliorates and makes reduces the negative drag from that fairly meaningfully. So I think that should help the performance going forward. And
because
then the
we're on the
third thing,
Canadian market.
That's right. So you're getting the distribution net of whenever you look at JEPI's. If you're a Canadian and you're looking at JEPI's yield, you don't get that yield. You get 85% of that yield because it's net of
15% less. Yeah.
Right. Or if you look at Q yield, but if you look at QQCC, which is in Canada, if you look at its yield, you get that yield.
Yeah.
So the yield net of withholding taxes for QQCC and USCC is notably higher than their US counterparts, net of withholding taxes. So the yield we're getting is a higher yield and it's a pure yield. So that's a plus. And then the third thing is the cover call strategy, and I'm not commenting on which one is better or worse. They're different, and I'll leave that. You're the expert, Adrian. But
they're different.
The fact is, and here we are today, QQCC, USCC, they write. It's very much like our new Canadian Financials Yield Maximizer ETF, writing at 50%. So you get the upside of 50%. So we feel that by adding these positions, should the market recover, we're going to get a greater participation of that recovery by virtue of making this shift. So we think there's 3 big advantages to making this change. But also, going back to the distribution, we think that these 2 ETFs will have a more stable distribution because it's not quite as formulaic. And so we think they can provide quite a bit more stability, and they have more flexibility on the underlying. So we think some of this variability that you've seen in these charts will be, not some of it, some of that volatility will be less than what you've seen up to this point, which we hope translates into more stable distributions and less conversations about payout ratios.
Yeah, makes total sense to me. And do you guys intend to keep a portion of QYLD, RYLD, XYLD, or you're thinking of getting rid of them altogether?
I think we do an ongoing review. So we still hold them. Every quarter we review the portfolio for lots of alternatives. So I think they're here for now, and they're here now. And I think based on changes in the market environment and based on our views on volatility, then we may or may not make changes, but they're holdings for now.
Yeah, and in case my audience is wondering why is he saying it'll have more upside, it's because QYLD, RYLD, XYLD, of course I'm going to be discussing this all in the 2 videos that are going to come out. Right. They write at the money on 100% of the portfolio. Right. So this is the most aggressive. It's full coverage, which means you're giving up all the upside, whereas the QQCC and the other one there, USCC, 50%. So you're capturing a lot more of the upside. So that's where the cover call strategies are different. There's always 2 variables with cover call strategy, guys. It's the coverage, which is a percentage, 50%, 100%, and the moneyness of the options, which are out of the money or at the money. We'll explain that in the next couple of videos coming up. So that makes complete sense. So yeah, that's pretty much all. I think we covered everything. The explanation was sound. I have maybe a few questions we could, I did a Facebook poll
Sure.
today. Number one voted question: to avoid future cuts and even technically increases, right? Increases,
Mhm.
decreases. Why not just make the distributions variable like JEPI and JEPQ and have like a set in stone payout ratio of 100%, and just, even if there is variability, make the distributions variable, and that's okay. Why are you guys choosing to do more
Yeah, I mean,
stable?
I mean that we could think about that. I think for now we think most people would like mostly stable distributions or consistent distributions. I do think that we'll be able to deliver that in part because some of the substitutions we've recently made take some of the volatility, or the covered call strategy should give us more upside and more stability in the distributions. Having
Yeah.
said that, we do really like the JP Morgan ETFs. They're very good ETFs, so we like them. But that wasn't the question. The question was, have we thought about making it variable? I think it's we'll think about it. I think we like this paradigm that we explained where, let's see if we can be at 99, but we don't want to be overly dogmatic about it. So if it goes to 100, we're okay with that because we feel that, we have two objectives, well, three objectives. We want attractive monthly income. The second objective is we'd like distributions to be as stable as we can make them. And the third objective, which underpins everything, is we want it to be a good fund over the long term. And in order to be a good fund over the long term, we want the distributions to be fully funded.
Yeah. And
So we're gonna trade off those three variables in any given month, but over a 1, 2, 3 year period, that payout ratio is going to be less than 100.
okay. So do you guys have a set in stone payout ratio, or would you say it's going to be approximately 99 to 100?
Yeah, no, I don't really like set in stone as a concept. I mean, I think we want to be practical and we want to be reactive to the market, and because there's so much volatility in the market, we're not talking about the VIX, but just things moving up and down. We want to be a buffer to a lot of that underlying volatility. So if we want to give you exposure to JEPI and JEPQ and all these other funds, we know that they have variable distribution, but we hope one of the benefits that people who want exposure to those ETFs and buy HYLD, that one of the things they're hoping for is that we're going to be able to diversify away some of that volatility. We can't eliminate it, as we saw, as was apparent in this particular month, but we'd like to soften it. And so I think we'll still just take a practical approach going forward. Maybe we make it a bit more formulaic going forward, but I think to the extent we decide to do that, it's still not going to give you a lot of volatility.
Okay. Yeah, no, it makes complete sense to me. And nothing is, let's say the distributions actually start reversing course. So if the markets keep going up and up and up, and the NAVs go up for Q yield, R yield, X yield, the distributions,
Mm.
which are based on the NAV, which I'm going to show, they're going to go up. So if you're starting to get back to that 2%
Yes.
buffer, you guys would consider obviously the inverse of re-raising the distribution.
Yes, definitely. And so, in fact, we've raised the distribution twice for HDiv. We raised it once for HYLD. It hadn't quite gotten to 2%. We probably got, it got close enough. I think at the time we thought it was going to keep rising, but it did not. But yeah, obviously, if the payout ratio gets to 98, then like I said, we really want it over the long term to be somewhere around 99. But yeah, if it got above that, then it would absolutely be a review for increase.
Sounds good. That
And
was my
it very well might. I'm not making it. I can't make any predictions, but if JEPI and JEPQ's distributions go way up, well, that's going to give us some flexibility, and then I guess we'll have to weigh that against if the distributions go up modestly and down modestly. How our unit holders feel about that.
that's the conundrum, because JEPI and JEPQ's distribution will go up if the VIX goes up, which means the
Mm,
market goes down. But Q
mm.
yield, R yield, X yield is the opposite, so it kind of balances out. But yeah, don't want to get into too much detail. So Rob, I mean, I think you answered everything. You did a fantastic job. You showed the charts again, guys. Read the article; it was all laid out in the article. But my closing remarks to my audience is remember what H yield and H div, by the way, also what they are.
Mhm.
They're just flow through funds, they're middlemen. So the distribution is literally based on what the underlying or the distributions of the underlying ETFs times 1.25. That's because of the leverage. So you have to the key to understanding not only HYLD and HDIVs distribution and distribution increase or decrease is you have to understand the distribution policies of the underlying. And for H yield, it's very important that you understand how JEPI and JEPQ work, how QYLD, RYLD, XYLD work. And of course, I have you covered 4 videos on those, 2 coming up, 2 already done. So, and another thing, this should be comforting for long-term investors because it's very transparent. You see the payout ratios. You see that Hamilton, Rob here, they don't want to grind. They don't want to do bad rock. They want to provide a good fund for the long term and not over distribute. So this should be a comfort for conservative investors. And you got to expect varying distributions because these are not dividend stocks. These are covered call ETFs, which change, the distributions change based on volatility. So that's
Yeah.
my final piece. I hope this was good for the audience. And Rob, if you want to add anything.
Yeah, I was just going to say, so first of all, we do think there's very strong reasons for owning both HDIV and HYLD, and not because we have 2 funds, but because the Canadian and US equity markets, their sector mixes are highly complementary. So
Yeah.
you have excellent tech and healthcare, among other things, in the United States. I'm just throwing out a few. In Canada, you have great financials, and you have strong resources, and you put them all together, and it makes for a pretty good complementary mix. And if you had HDIV and HYLD, HDIV has done very, very well. There's going to be times when HYLD outperforms and HDIV doesn't.
Yeah.
But if you own the 2 together, that makes a lot of sense because it's the Canadian and US equity markets. But it also diversifies away, a lot of the issues that we've talked about, whether it's related to performance, distribution consistency, distribution levels. It makes sense to hold them both together, in our opinion. And if you go on our website and look at the insight that we posted, you can see a 50-50 portfolio of HDIV and HYLD is right in line with a 50-50 portfolio of XIU and VSP, and that's where we want to be.
Yeah. So in short, total return wise, even though
Mhm.
the yield is much higher, these are covered call strategies which typically underperform the indexes long term.
Correct.
You're pretty much in line. And I have to give props to again the leverage. The leverage is what gives that, my
Mhm.
opinion here, what makes this stuff
Yeah.
special and gets you up. Because let's be honest, it's very hard to beat the indexes. Right now, HDIV is blowing away XIU. HYLD is slightly underperforming VSP, but like you said, it's because the U.S. market has underperformed more than the Canadian market because of inflation that helps resources and financials and stuff like that.
Right.
So I
And
agree,
and
very healthy complementary
yeah,
sector mix.
absolutely. And the other thing I was going to point out
Yeah,
is that the leverage is modest, but what it does do is the volatility profile of HDIV and HYLD is not meaningfully different, even with modest leverage, than the volatility of the underlying constituents. Because when you put them all together, there's a diversification benefit that brings the volatility down, and then the modest leverage brings it roughly equal to where it was. So if you're okay buying an individual sector covered call ETF, if you feel good about that, or you feel comfortable with the risk profile of that, you should feel comfortable with HDIV and HYLD because their volatility profile, not for every single one, and some it's lower, some it's higher, but it's pretty much in line. And
yeah.
so the leverage is modest, but it does help, and the power of compounding over time. Hopefully, the markets eventually go up. Will help you both get a higher monthly distribution, but as well offset the drag of the cover call strategy.
Yeah, it makes perfect sense because cover calls lowers volatility, leverage increases it, so you kind of have
Yeah.
the balance out there. And you're saying basically they're pretty much proximately as volatile as the
Well,
indexes
yeah, I
with
mean,
that
sure.
leverage.
I mean, owning a gold fund or an energy fund has a lot more volatility.
For sure, a lot
Or
more.
even, I mean, maybe healthcare is a bit lower, but financials can be volatile. But you put them all together, volatility by sector, diversification brings it down, leverage brings it up modestly, and you're really in line with the volatility profile of a sector covered call ETF.
All right, perfect. So Rob, again, thank you so much. We're actually going to be doing this again next week because we're scheduled to do a review of your new. We're going to talk all about the banking ETFs this time. We're going to focus
That's
on the
right.
new equal weight ETF HEB. We're going to talk about HMAX as well. We're going to talk about all
Yes.
your financial because that's basically Hamilton ETFs and even your expertise. You're really an expert in Canadian. You know, I see you all the time on BNN. You're talking about the
We
banks. So
try.
we'll ask you some questions about the Canadian banking sector. I know the US banking sector had a little bit of a scare. I'll ask you
Mhm.
all about that. So I'm excited to talk to you next week. We'll chat then.
I look forward to it.
All right.